welcome to the deep dive.
Yeah.
Um, have you ever found yourself, at the grocery store, just staring at the receipt and thinking, wait, why? Why does everything suddenly cost more?
Oh, definitely. Or maybe you're thinking about switching jobs and wondering if it's, well, a good time or if things feel a bit tighter out there.
Exactly. We all feel the economy sort of bumping up against our daily lives.
Yeah.
But then you see headlines about the Fed or inflation projections, and honestly, it feels like a totally different language sometimes.
It really can seem that way. Very abstract. But those headlines, they actually connect directly to your wallet, your job hunt, even things like your savings account interest.
Right.
So today we're going to dive into the latest economic projections from the Federal Reserve. Think of it as their best guess about where the U.S. economy is heading.
Okay, let's try to unpack that then. Our mission today is really to cut through the jargon, understand what these forecasts, specifically from the FOMC, the Federal Open Market Committee, what they actually mean for us. We'll look at the numbers, sure, but also, what's behind them and why even the experts say, hey, we're not 100% sure.
That's the key takeaway. These projections came out of the FOMC's meeting just recently, June 17th and 18th, 2025. It's where all the key Fed people share their views on, well, the big stuff. GDP, unemployment, inflation.
And that Fed funds rate thing.
And the federal funds rate, absolutely, the one that influences almost every loan.
Okay, so let's start with the basics then.
Right.
Real GDP growth. Sounds important, but what is it really?
Right. So real GDP, think of it like the total annual income of a giant household. That household is the entire country.
Okay, like everyone's income added up.
Sort of, yeah. More accurately, it's the value of everything the country produces, goods, services. When real GDP grows, it means the country overall is making more stuff, earning more money. It's kind of the main pulse check for economic health.
Gotcha. Like if my favorite coffee shop sales go up year over year.
Exactly. That's like it's GDP increasing. It's doing well. So the Fed's latest median projection, their middle ground guess for the country's real GDP growth in 2025 is 1.4%.
1.4%. Okay. And they think it'll get better after that.
They project it ticking up slightly, yeah, to 1.6% in 2026 and 1.8% in 2027. It's interesting because just back in March, they thought 2025 would be a bit higher, like 1.7%. So a slight nudge downwards.
Okay. Still growing, but maybe a little slower than they thought. What about the unemployment rate? That one seems more straightforward.
It is mostly, it's just the percentage of people in the labor force. So people who want to work and are looking who can't find a job right now. Lower number, generally better.
So like a sports team's injury list, low number means everyone's ready to play.
That's a great analogy. Yeah, a low unemployment rate means most of the players in the economy are active and contributing. For 2025 and 2026, the Fed's median projection is sitting at 4.5%.
4.5%. So how does that compare? Is that considered low?
Historically, it's pretty low, yeah. Still indicates a relatively healthy job market. They see it maybe drifting down a tiny bit more to 4.4% in 2027 and then settling around 4.2% in the long run. Again, slightly higher for 2025 than their March projection, which was 4.4%.
Okay, so job market's still pretty solid, but maybe loosening just a tiny fraction. Now,
Inflation.
PCE inflation and core PCE inflation. This is the one I think everyone really feels, right? The cost of, well, everything.
Absolutely. This hits home. PCE stands for Personal Consumption Expenditures. It's basically a measure of price changes for pretty much everything consumers buy. Think of it as the inflation rate for your entire shopping cart.
My whole shopping cart. Okay.
Yeah. Now, Core PCE is the same idea, but they take out food and energy prices.
Why do that? Food and energy are huge parts of my budget.
They are. But those prices can swing wildly. Bad weather affects crops, global events affect oil. Core PCE strips those out to give a clearer view of the underlying, more persistent inflation trend. Is everything else getting more expensive too?
Ah, okay. Like trying to see the overall trend without the big spikes from, say, gas prices.
Exactly. So if PCE inflation is 3%, your overall shopping costs 3% more than last year. Core PCE helps see if it's broad-based or if it was just, I don't know, avocados having a really expensive month.
Right. So what are the numbers here? Are avocados having a bad year?
Well, the projection for overall PCE inflation for 2025 is 3.0%. That's expected to come down gradually, hitting 2.4% in 2026, and eventually their 2.0% target in the longer run.
3%. Wow. So still noticeably higher prices.
Yes, and Core PCE is projected even a touch higher for 2025 at 3.1%. And here's the thing, both of these are higher than what the Fed predicted back in March. PCE was 2.7% then, Core was 2.8%.
So inflation is proving stickier than they thought a few months ago.
It seems that way, yeah. Progress is being made, but maybe a bit slower.
Okay, that definitely explains the grocery receipt feeling. All right, last big one. The federal funds rate. This always sounds like the master control panel.
That's a really good way to put it. It kind of is. It's the target interest rate banks charge each other for overnight loans. Seems obscure, right?
Yeah, like why do I care what banks charge each other?
Because the Fed uses that rate as its main tool. When they change that target, it sends ripples everywhere. It affects the interest rates you pay on mortgages, car loans, credit cards, even what you earn on savings.
Ah, okay. So it's the starting point for all other rates.
Pretty much. Think of it like the economy's speed limit set by the Fed. If inflation is too high, they raise the speed limit, making borrowing more expensive to cool things down.
And if the economy's slow, they lower it to encourage spending and borrowing.
Exactly. They lower the speed limit. So the projection now, for 2025, the median guess is 3.9%. Then they see it gradually declining 3.6% in 2026, 3.4% in 2027, aiming for 3.0% in the longer run.
3.9%. That still feels pretty high compared to a few years ago.
It is. It reflects their effort to keep inflation in check. Interestingly, while the 2025 projection is the same as March, they now see rates staying slightly higher for longer in 2026 and 2027 than they did previously.
Okay, this is where it gets, well, maybe a bit confusing for me. These are all projections, guesses.
Yep.
And the Fed's own report talks about considerable uncertainty. Why? If they have all this data, why can't they just know?
It's such a fundamental question in economics. The simple answer is, well, the economy isn't a machine. It's driven by millions of people making decisions, plus global events, unexpected shocks, what the report calls myriad unforeseen development.
Like a pandemic or a war.
Exactly, or even just shifts in consumer confidence, new technologies. It's incredibly complex. Think about predicting the weather perfectly weeks in advance. Even with amazing models, a small, unexpected shift can change everything. Economics is kind of like that, but maybe even harder.
Yeah. Well, how do they deal with that? Just say it's uncertain and move on.
Oh, no, they actually try to quantify it. They provide error ranges or confidence intervals around their main projections. These are based on how far off their past forecasts have been.
Like saying, we predict 1.4% GDP growth, but honestly, based on history, it could easily be anywhere between, say, negative 0.3% and plus 3.1%.
Precisely. They actually publish those ranges. For 2025 GDP, the 70% confidence range based on past errors is roughly plus or minus 1.7 percentage points around their median forecast. That's a huge range.
Wow. Yeah, so the 1.4% is just the middle point of a very wide target.
Exactly. It tells you there's a lot of room for surprise. They do the same for unemployment, inflation, the interest rate. It acknowledges the inherent fuzziness.
Do the Fed people themselves agree on how uncertain things are?
That's another interesting bit. They each individually assess if they think uncertainty right now is higher, lower, or broadly similar to the past. For GDP and inflation, most feel it's broadly similar. But for the unemployment rate, opinions are more mixed. Some see higher uncertainty there.
Okay, so there's uncertainty, the range of possibilities.
Yeah.
But then the report also talks about risks. What's that about? Is it different?
Yeah, it's slightly different. Uncertainty is about the size of the potential errors. Risk is about the direction. Are things more likely to turn out better than the median projection or worse?
Ah, okay, so like you predict your team will win by 10 points, median, but you think the risk is they might actually lose, downside risk.
Perfect analogy. Weighted to the upside means outcomes might be better than the forecast. Weighted to the downside means they might be worse. Broadly balanced means the chances are roughly even.
So what are the risks looking like now, according to the Fed folks?
For GDP growth in 2025, actually, more participants see the risks as weighted to the downside, meaning quite a few of them suspect growth might end up being even slower than their 1.4% median guess.
That's sobering. What about inflation?
For PCE inflation in 2025, they see the risks as broadly balanced, so equally likely to be a bit higher or a bit lower than their 3.0% projection. And what's fascinating is even with all this uncertainty and these downside risks for growth, the actual spread of individual forecasts among the FOMC members isn't that wide. It's much narrower than those big historical error ranges.
So they generally agree on the path, even if they know the exact destination is fuzzy.
That seems to be the case, yeah. It suggests a degree of consensus on the overall direction, even while acknowledging things could easily get knocked off course.
Right. So let's bring it all home. We've got GDP growth maybe slowing a bit, unemployment still low, but maybe ticking up fractionally, inflation staying stubbornly high for a while longer, and interest rates staying up there too. What does this mean for, regular people listening, for you?
Let's connect those dots. Slower GDP growth, like that 1.4% projection, might mean the job market isn't quite as red hot. Fewer new positions opening up, maybe a bit more competition for jobs. Still positive, but less booming.
Okay, and the unemployment rate at 4.5%.
Yeah, that slight projected increase suggests things might loosen up a bit. Could mean it takes a little longer to find a new job if you're looking. Maybe wage growth doesn't continue at the really fast pace we saw recently.
Makes sense. And inflation at 3.0%, that's pretty direct.
Absolutely. It means your money just doesn't stretch as far. That higher grocery bill, the cost to fill your tank, rent, it's likely to keep feeling elevated. The projection is for it to slow down over time, eventually getting to 2%, but 3% still bites into purchasing power right now.
Definitely feeling that bite.
Yeah.
And the federal funds rate staying near 4%.
Means borrowing stays expensive for a while longer. If you have a variable rate mortgage or credit card debt or need a car loan, those rates will likely remain relatively high.
But there's a flip side.
There is. If you have savings, particularly in high-yield savings accounts or CDs, you'll likely continue earning pretty decent interest on your cash, at least while the Fed keeps rates up. That's projected to ease later, but for 2025, savers might still see good returns.
Okay, so some pain for borrowers, maybe some gain for savers.
That's often the trade-off. And remember, the Fed's juggling act, their dual mandate from Congress, is to aim for both maximum employment and stable prices, which they define as that 2% inflation target. These projections show how they're trying to navigate that path using the tools they have, mainly that federal funds rate.
It really is a balancing act, isn't it? Trying to cool inflation without crashing the job market.
Precisely. It's incredibly difficult.
So, okay, ultimately, these projections are like the Fed's map of the economic road ahead. It's got some bumps, maybe some unexpected turns, definitely some fog obscuring the view.
That's a good way to put it.
But they're actively steering, trying to keep us heading towards that stable place with lots of jobs and prices we can actually handle. It's a good reminder that even if we don't know the future, these experts are constantly watching the dials.
Absolutely. And it leads to a really interesting question to leave you, our listener, with. Given all this uncertainty they acknowledge, given the slight shifts just since March, what unexpected event, something maybe not on their main radar, global or domestic, do you think could be the real wild card here? What could potentially knock these careful projections significantly off course in the next, say, year or 18 months?
That is a really good question to chew on. What's the big unknown out there?
Well, thank you for joining us on this deep dive into the Fed's crystal ball, or maybe their slightly foggy crystal ball.
Yes.
We really hope this has helped make sense of those headlines and what these economic numbers might mean for you.
Goodbye for now.
Until next time, keep digging into the details and stay curious. Goodbye.